Okay, let us continue about the ratio based on capital balances, allocation of profit based on capital balances. Yeah. So the allocation of profit based on the ratio of capital balances may result in equitable allocation when invested capital is considered to be more important factor and or the partnership operation require little from the partners time. So the capital balances may change during the period whether using method 1 or method 2 in use. For example, we need more capital, so there will be injection of capital by some partners. So this will increase the capital contributed. Okay, let us look at this example. We have two partners. First is Becker. His capital investment is 150,000. This is Becker. Whereas for Cook, the capital that he contributed is 100,000. So the total amount of capital contributed by both partners is 250,000. So this is the total. So when the business make profit of 60,000, the business make profit of 60,000, how are we going to divide this? Yeah, this will be a very dramatic situation. They keep fighting, yeah, and who should get more. That's why you need to have the partnership agreement. So the partnership agreement say is based on the opening capitals or capital contributed by the owner. So for Becker, the formula will be 60,000 multiplied by 150 over 250. 150 over 250. So Becker will get 36,000. Cook will get less. Since he contribute less, it's going to be 100 over 250 multiplied by 60,000. That give it 24,000. So Becker will have this 36,000 profit sharing, profit shared profit, whereas Cook will get 24,000 profit based on the proportion of capital investment. Okay, so how are we going to record that? If you use the method number 1, only one account, this 36,000 will increase the capital of Becker, will increase the capital of Cook. If you use the method number 2, we are not going to change the capital account. We're going to create a new account. We call it as a retained profit for Becker and retained profit for the Cook. The amount is the same. Either it's going to be go to the capital or to the retained profit. So in your final exam later on, please be careful. What are the methods requested? Are you going to use the fixed capital accounts, or you're going to have only one single capital account? So this is the thing that will be asked during your final exam. Another way of doing this profit allocation is by using fixed ratio after allowancing for interest and salaries. Often, individual partner make unequal capital contribution and the amount of time and the nature of service performed are not the same. Even though maybe Cook contributed less amount of capital, but he did spend a lot of time work or supervise the business operation. So it's not fair to only rely on the capital investment. So we have another methods here that is after allowing for interest and salaries. So a profit allocation method that contain a provision for interest and or salaries must be included in the partnership agreement. So for example, the interest on capital, we give certain rate for the interest on capital, the new item here, interest on capital. So we give this 10% for the amount contributed. So since Becker contributed 150,000, Becker entitled to get 15,000. Cook contributed less. Cook only contributed 100,000, so he should get 10,000. Salaries to partner by credit. Okay, Becker work full time, 12 hours a day, so you're going to pay him 18,000. Cook only work part time, 6 hours a day, So he should entitle for only 10,000. So this is what I call as salaries. This is the plus interest plus salaries. So the total interest and salaries will be 33,000 for Becker and 20,000 for cook for cook for cooks. Okay. If you still remember, we have 60,000. Now we pay the interest. How much we pay the interest? 15 and 10, that's 25,000. That is 25,000. So you have a balance of 35,000. From this 35,000, yeah, you paid salary 18,000 and also another salary 10,000. So 28. So the balance now is 3,000. No, so the balance now is 7,000. 7,000. Let me put it here. 60,000 minus 25,000. This 25,000 is 15 and 10,000. So you have 35,000. This 35,000 you minus with another 28,000. 28,000 is 18 and 10,000. Yeah, from here 18 and 10,000. So the balance is 7,000, and this 7,000 you would divide equally among partners. So 3,005 for Becker, another 3,005 for Cook. So the total equity increase is 36,500 for Becker, another 23,500 for Cook. So this is method, we call it as the fixed ratio after allowing for interest and salaries. Fixed ratio after allowing for interest and salaries. So what will be the journal entry if you use this method number one? Is going to be very easy. First, 25,000. You're going to reduce the profit, take it up from the profit, 25,000, transfer to the capital. This is method number one. Only one account exists, that is capital. And then the second one is about the salaries. You're going to take out from the profit, take out the salary, 28,000, and increase the capital for Becker, increase the capital for Cook. Okay, we don't use any accounts, just put it as reduction or reduction in the profit. Yeah, increase the capital of Becker, increase the capital for Cook. And finally, the profit distribution 7,000. For the balance 7,000, we're going to transfer 3,005 to the capital of book. Sorry, capital of Becker, and another 2,500 increase the capital for Cook. So this is method number one. Always remember, method number one, we only have capital accounts. Okay. For method number two, it's a bit complicated there. We don't have we still have the capital account, but we're not going to touch the capital account. We're going to use the retained profit account. So instead of using the capital account, I'm using the retained profit or retained earnings account. So debit the profit and loss, credit the retained earnings for Becker and Cook. For the profit distribution, this one also same thing. For the salary, we're going to transfer to retained profit account. And finally, for the balance of the profit, we're going to transfer to retained profit or retained earnings account. So that are the differences. There are the differences. Number one, we make changes to our capital accounts. Number two, we're not going to change anything to our capital account, but we're going to create a new account known as the retained profit accounts. Okay, let us move to drawing and loan made by partners. Yeah, it's common. Yeah, when we run business, suddenly the partners run out of cash, need to pay the children tuition fee or school fee. So he will go to the business, ask for loan, or would like to withdraw his capital, or will use the capital money to pay his personal expenses. So that's common in a partnership business or any kind of business. Okay, so Partners may withdraw cash or other assets from the partnership to provide for their everyday living needs. So under method number one, no distinction is made between withdrawal of capital and withdrawal of profits. Hence, all withdrawal will go to the drawing accounts and then are going to credit the cash at bank. So under method number one is going to we are going to create the drawing account. This drawing account will be is the contra capital account. So we're going to use this drawing account. Okay, that is method number one. Method number one. So in this method number one, if you look here, this is the profit. This is the profit that we have before that. So this is the allocation based on capital. So this is method number one. Method number one. We only have capital accounts, no retained earnings or retained profit accounts. But if you use the method number two, we have the capital accounts, and on top of capital accounts, we have the retained earnings account for Becker and retained earnings account for Cook. So you can see now we have two set of accounts, capital plus retained earnings, another one capital plus retained earnings. So this is the difference between method one and method two. Yeah, this is method one, only one accounts that is capital. For method two, we have two accounts, capital and retained earnings. Capital and retained earnings. Okay, now we move to drawing. What is drawing? Partnership may withdraw cash or other assets from the partnership to provide for their everyday living needs. So they might take cash or use some of the facilities or take asset for their own personal use. So that will fall under drawing. So under method number one, we're going to record that as a withdrawal. We're going to debit the drawings accounts. We're going to debit the drawing accounts and we're going to credit cash if the drawing in terms of cash. So this drawing account will reduce your capital accounts. This drawing will reduce your capital accounts. But under method number two, the withdrawal of capital by Cook is directly debited to the capital accounts, okay, and other drawing can be taken from the retained earnings. So we have to assess whether the drawing, if withdrawal of capital or other drawing. If withdrawal of capital mean the partnership take out his capital out, so we're going to record it in the capital account. This is the capital account. For example, you contribute 150,000, so you're taking out 50,000. So this will be drawing of capital. Or another way is by looking at the retained profit, retained earnings. Maybe your the retained earnings balance here is 5,000. So he's taking out only 1,000 from the retained earnings. So it varies. Yeah, you have to read the question carefully. So on top of that, there is also charges. Yeah, charges to the partners who withdraw money. We want to discourage drawing of capital or drawing made by the partners. If they contribute capital and started drawing money, so the business will run out of cash. Yeah, the business will run out of resources, not enough resources to run the business. To discourage this, so it might be a good policy to charge interest on drawing. So if they want to withdraw money, they know that they will need to pay some charges there. So that will be an expenses for the business, sorry, and expenses for the partners, but it's going to be revenue for business. So interest on drawing is not normally paid by the partners into the partnership, okay, but is added to the profit distribution. What does it mean? When you charge interest to the partners, the business profit will increase. All right, the business profit will increase, and then we're going to deduct from the capital, So we're going to reduce the capital, but we're going to increase the profit, and also from retained method earnings if you use the method number two. Yeah, interest on drawing is a revenue for business. It's a revenue for business, but it's going to reduce the capital for the partners. How about loan or advance by the partner? A partner may lend money to the partnership rather than investing the money. You should invest the money. Now you're borrowing the money from the partnership as a further capital contribution. So such an advance of money is correctly treated as current or non-current liability of the partnership and is counted for using the following journal entries. How are we going to record that? We're going to debit maybe the loan, maybe the loan receivable, yeah, the amount receivable from the partners, and we're going to credit the cash, maybe. Let us look at this example to illustrate. Assume that during the year ended 30th June 2020, Becker withdraw 14,000 cash. Becker took 14,000 cash. Cook also do the same thing, withdraw 8,000 cash. In the expectation, what is the date? 30th June. 30th June. Okay, this is the financial year end. This is financial year end. So Becker withdrew on 31st December. That is 6 months before that. Cook withdrew on 31st March 2020. So let us look here. This is our accounts. Financial year end, 30th June. 30th June, Becker withdrew 14,000. When? 31st December. 31st December 2019. This one 2020. So how long this thing? 6 months. So we're going to charge interest for 6 months. On the other hand, Cook withdrew this C. This is B. Cook withdrew 8,000. 8,000. Okay. 8,000. So this 8,000, the transaction happened on 31st March. So 31st March 2020 to 30th June 2020. So this will be 3 months. This is 3 months, yeah? 3 months. So you're going to charge interest 3 months to Cook and 6 months to Becker based on number. The longer, yeah. So we want to discourage withdrawals, yeah. We want to discourage withdrawals. Okay. Assume as well that owing to the unforeseen circumstance, Cook decided to withdraw 6,000 of his capital. He want to take out his capital in cash on 31st May 2020. So this is withdrawal of capital 6,000 by Cook. Cook withdraw another 6,000. So the accounting treatment for this variable depend on whether method 1 and method 2 is being used. Whether you're going to use method 1 or method 2. Under method 1, no distinction is made between withdrawal and capital and withdrawal of profit. All go to the drawing accounts and we're going to charge it to the partner's capital at the end of the day. But under method number 2, we need to classify, ascertain whether the drawing is in the form of retained earnings, the profit, or drawing of capitals. So under method 1 is easy. For on 31st December, debit Becker's drawing account 14,000, credit cash. Very easy, very straightforward. Okay. And then when Cook withdraw money 8,000, debit drawing, credit cash. Yeah, because cash reduced. On 31st May, debit drawing, yeah, debit drawing, credit Bank, same thing. Debit drawing, credit bank. So it's the same. No distinguish, no difference between drawing from the retained earnings or drawing from capital. Everything is considered as drawing. It will reduce the capital. Okay. So at the end of the day, you're going to debit the capital accounts, reduce the capital accounts of backer, debit the capital accounts, credit drawing. We close our drawing accounts and we're going to minus our capital accounts. So this is the process and the method number one. Indirectly, at the end of the day, the capital account will reduce because of the drawing. Because of the drawing. Okay. For cook, we're going to combine this 8,000 and 6,000. We combine this and this give you this amount of money, 14,000. Yeah, 14,000. So this come from this one. Yeah, 14,000. No, we don't distinguish between drawing in terms of retained earnings or profits. Yeah, for the method number one. So this is very easy, very straightforward methods. However, when we deal with method number two, it's going to be different. It's going to be different. What I mean is the drawing, as usual, debit drawing, credit cash, debit drawing, credit cash, debit drawing, credit cash. Okay. But for the next one here, this one is drawing of capital. So I'm not going to debit drawing. I'm going to debit capital account. So indirectly, the capital account will reduce. Can you see this different? Yeah. The capital account will reduce by 6,000. Okay. And then for the balance, the different there, the 14,000 will be deducted from the retained earnings, not capital accounts, and the balance 8,000 also be deducted from the retained earnings account. That is the difference between method number one and method number two. Method number one, we're going to debit drawing, credit cash. At the end of the day, we close our drawing account, credit drawing, debit the capital accounts. For method number two, you need to distinguish whether there's a capital drawing or retained earnings drawing. If retained earnings drawing, very easy. Debit drawing, credit cash, debit drawing, credit cash. At the end of the day, you're going to you're going to credit your drawing accounts and debit your retained earnings account. But however, for drawing in terms of capital, straight away you're going to debit the capital accounts, credit cash. Credit cash. So another important thing when we have this drawing is we're going to charge our partners with certain interest on that. So it will be the business income, but it will be expand for each partner. So for example, we're going to charge 8% interest per year. So backer will draw 14,000. So 14,000 multiplied by 8% multiplied by 6 over 12. So this is the amount that we're going to charge backer. Backer has to pay 5,600. Normally they don't pay. They offset with their capital account. Okay. For cook, this is for the 3 month. For the 3 month, 8,000 multiplied by 8%, 3 over 12. So the charge is 160. And finally, for drawing of capital, there's only 1 month. It's 31st May until 30th June. So we're going to multiply 6 multiplied by 8%, $40. So these are what we call as interest on drawing. It will reduce the capital or the profit of the partner, return earning of the partner. Okay, so how are we going to record this? I'm going to debit capital, backer, 560, credit capital for cook, 200, and that will go to profit distributions. If you use method number two, certainly you're not going to touch the capital account. You're going to charge it to your retained earnings account. Retained earning for backer and retained earning for cooks. For cook, yeah. So if you look here, interest on capital credit, salaries on partner credit, it will increase the capital or the retained profit. Interest on drawing debit. What does it mean? Interest on capital debit, you have 150,000, for example. This is your capital. I'm using method number one, yeah. Interest on capital mean you get this 15,000 as a reward. So your capital grow, and then you also get salary. So your capital also grow by 18,000. And now when you draw money from the business, you only not only you take out the money, but we're going to charge you 560. So this is the amount you're going to minus. Interest on drawing reduce your capital balance or your retained earnings balance. So the last part will be the financial statement for a partnership. If partnership is not reporting entity, you prepare a special purpose financial statement and must be clearly stated. But if partnership is a reporting entity, then it must prepare the general purpose financial reports, yeah, the standard financial statement complying with the Australian Accounting Standard Board or International Financial Reporting Standard Board or other standard, other applicable standards, yeah, applies to that particular country. Each partner's equity in the business is reported separately on the balance sheet or in separate statement of changes in partner's equity. So we have one section for the capital. We're going to split it to detail breakdown for each number of partners, for each partners. Okay. Salary authorized for each partner, interest on capital investment, and interest on drawing are not reported as expense. We're not going to put it as expense, but we're going to put as allocation of profit. So your profit that you report is before deducting the salaries for partners, before deducting the interest on capital, or before adding the interest on drawing. There is no income tax expense since partnership is not legal entity and not subject for tax. So who should pay tax? The partners pay tax. The partner. The profit or loss allocation for the period is normally disclosed in the financial statement, is prepared separately, sorry, in a separate statement of changes in partners' equity. So as a summary, there are major attributes of partnership. There are many attributes that I have highlighted. There are advantages of the partnerships and also the purpose of partnership agreement, the importance of partnership agreement, and what is the special feature applicable to accounting for partnership. I always remember that we have method number one and method number two in recording the interest of the partners. I did show the entry for the formation of partnership. We record the assets at fair value, not at carrying amount. The accounting entry for allocation of profit, how we're going to define the profit, is it based on opening capital or fixed ratio after deducting the interest or interest and capital. The accounting interest entries for drawing and advance, and also the content of financial statement of the partnership. I think with that, I end my presentation. Thank you so much for joining, yeah, the session.